Hey, Dustin Tibbetts with Passport to Wall Street, and we're going to do a trade of the week today. With the markets being so volatile, there's a lot of opportunity out there at the moment, but we want to be sort of clever or crafty about how we go about positioning ourselves in case that volatility continues. So we're going to focus on a trade today. We may do a few of these, but today we'll use one particular symbol and see how you might be able to apply that to other stocks if you find something similar that you're interested in. So the stock that we're going to focus on today is Morgan Stanley, symbol MS, and let's go over to the charts to take a look. Here's what's happened. This stock has fallen very aggressively. In fact, if we go from the highs all the way down to recent lows, we find about 14%. There's been about a 14% decline over the last few days, and that's just the markets being extra volatile. So what we'd like to do is say, what if this volatility stops? Maybe the stock doesn't bounce a whole lot, maybe it goes down a little more, but let's say that this almost 15% drop is enough, right? Like, what if this is the end of it? So let's dig in here and take a look. What I'd like to do is use options today for this trade. If you're familiar with options and want to participate, this is a great time to actually learn given the volatility in the market. So with Morgan Stanley, what I want to assume is that this 200-day moving average is going to hold. If we go back in history, we see that it stayed above the 200-day moving average, and this may be no exception. It may come down and touch it and head back higher, or it could stop right here for a while and then work its way back up. We don't know, but we want to participate using options. And so if the magic number is 50, we'd like to have an average cost that's under 50, give us a little breathing room. So we're going to go look over at the options. And if we go to the April monthly expiration, and we take a look at the $50 put, if we were to sell that put, we could get over $1 for that. What does that mean? Well, if we look a little bit closer, it means that we would be selling the $50 put, but our average cost would really be $49, give or take a little bit. And that puts us under the 200-day moving average, which is exactly where we want to be. So in this case, selling the $50 put will bring in about, let's say, $1.10 worth of credit. If you happen to be watching this later and it's bounced a little bit, no problem. Somewhere around 90 cents would be good too. So we have a lot of breathing room in this one. And what we're going to do is say we expect that this will stay above 50. Now, what's the probability that it's going to stay above 50? Currently, 65%. So 65% odds that we're going to make money on this trade. But remember, our break even is actually 49. So we don't get in any trouble until we get to 49. What's the probability of that? Well, if we go take a look at the $49 put, there's only a 30% chance that it hits 49. So we have a 70% chance of being profitable above 49. Although that profit would be a little smaller, that's still nice to know that odds are 70% that we're going to make something on this trade. So given the recent volatility in Morgan Stanley, it's given us this opportunity to sell a put for that much premium, being just a little bit under the price of the stock, but we have some breathing room. So this may not be a trade for everybody, but if you're exploring the idea of trying to use options for volatile stocks like this, I think you'll like this trade. I hope you enjoy. Look out for some more coming your way, and we'll talk to you soon.